Hey, traders. Okay, I am going to go through and do something a little bit different today. A little gift to everybody who follows my channel. And if you don't, well, you should. And start doing it now. Uh, in any event, we're going to take a look at this. We're going to look at some earnings and we're going to see if we can play some earnings trades. And I'm going to actually give you these trades before the market happens again so that you can take advantage of them and make some money and then take my course. Believe me, you will be so happy after you do. Your whole life will be different. In any event, so we're just going to go through a little bit of a process that I go through here. And today we're going to look today after market close. And I'm going to screen this out because I'm going to stick with the big names just for now. So I'm going to look for average volume over 2 million just to see, what the big names are that are coming out today. And I'm going to just screen this out. I'm going to say also over $10. Okay. So we have, now I usually like to sort these by industry, and, just to get an idea. So ITUB, nothing really there. SLCA, US Silica Holdings, don't really know that company very well. HTA, a REIT, and BRX, a REIT. OLIN, nothing really exciting there. As far as earnings today, let me just go look before the market opens. Mosaic, okay, look at filter these here. Under Armour, yeah. Okay, we're gonna launch it. We're gonna look at Under Armour. We're also going to look at see anything else here looks interesting. CNX, Shopify. Interesting. MOS, BP. We're going to look at a couple of them here, but we're going to start off with Under Armour. Okay, now, once I see something that I really like, now I happen to know this entire sector has been getting crushed lately, and this is a trade that I definitely want to look at. And you can see there's actually two here. One is Under Armour UA, and the other one is UAA, right? We'll trade obviously the one with the most volume and largest market cap. So we'll take a look at that. Now, as you can see, just over this last year, this stock has been getting beaten up pretty badly. However, we're bouncing today. Okay, we are bouncing today. Now, first things I want to go look at when we look at this, 1 second here, when we actually look at this is, the stock has just been getting, and I want to put UAA in here, UAA. The stock has just been getting absolutely crushed, and you can see that the last earnings season, the last earnings, it got hammered. Estimates were for 25 cents. It did not even come in at 25 cents. It came in at 23. Then the estimates were for -4. It actually beat and went higher. And then we have earnings today. So the earnings right now are for -6. All right, so we've gone from -4 estimates that were better, 25 cents that were worse, and now we're expecting -6. So we've really kind of priced in. The real question we want to ask is, have we really priced that in since the last earnings season? And the answer is not really. we really have not priced that in at all. If we did, the market would be lower than where it was, which was 1996, and it's actually higher. So this is looking pretty good. Now, the expectations are pretty bad, -6, right? So we know that they can probably beat that expectation, but the move has not been priced into the stock, which means that the market or order flow is expecting this to actually probably do a little bit better than -4, right? Um, so, or -6. So it is possible that we could beat -6. Okay, it is possible we could beat -6. So I wish that expectation was a little bit worse. I wish it was like, ideally, I would love that to be around negative, probably a little bit less than that, -3. But being able to beat -6 should not be that difficult. So that kind of puts us in a problematic situation because we definitely want to be shorting this asset. The problem is that they could beat very easily, and that could bring up some upside move. Now, looking at the actual order flow here, I see that there is a ton of liquidity probably still parked at 1841. And you might say, Steve, how do you know that? Those are two lows there. How is there, what do you know about that? And the answer is, I don't really know. I have to make some calculated guesses. And based on what I see, and I see liquidity on the top side has been taken out. In other words, we already cleared out all of these levels up here. I say the path of least resistance is 1839. And so, that's how we want to be trading this. We want to be trading this to 1839 after earnings. However, we have a problem. They could beat. Now, if they beat and they come in at, -0.4, -0.3, the market will have an upside move before it ends up turning around and having a downside move. Okay, so that's making this trade a little bit problematic. So now we have to kind of decide and design the strategy around that situation. Now, the first thing that comes to mind is, why don't we can't really short the stock right now because I think that it's a bit too risky. Unless you have the ability to trade after hours, even this, if you can trade it after hours, is going to be problematic because you're not going to really be able to, it's not going to be liquid enough. It's not a very highly liquid stock that you're going to be able to get out of. So the first thing that comes to mind for me is to sell some premium, right? And I would now just stop this video. Okay, so by the way, anybody that doesn't use this software, OptionView, I've been using it for years and years and years, on and off. It's really good. A lot of brokerage firms provide analysis software, and I kind of stopped using it because it's like $100, and I can do a lot of what I want to do inside IB, but I just like it. I really like the way it operates and the way it things. So during earnings season, I try to use it again, and I think I'll probably subscribe to it again because it's really good, and it does things that just regular brokerage software doesn't do. Now, what I'm specifically looking at here is I'm looking at implied volatility. Okay, now we're coming into earnings season. We can see that it's very typical that before earnings, and this is historic volatility here, that volatility will rise. But look at this number. I mean, this is pretty spectacular. We're about 55% on implied volatility. And so the market is really pricing in a very large move right now that, and I guess it's all based on that. We can make the assumption that um, it's based on this, -6%, right? I mean, that's why that would be high. So the reason we're looking at this is because um, we can take advantage of this situation if we decide to, if we don't see anything really revolutionary in the company, meaning that, this is some premium. These premiums are going to be very expensive. We really don't want to be buying any puts in this situation unless we really think there's going to be a big move. And after our analysis right now, we can clearly see that we do not think there is going to be a big move. Um, Even if they beat, which they could, the company's still sucking wind. So even if they beat, and they're at 4 cents, they're still losing more money than they ever did. So any move higher would be extremely temporary. Now, of course, there's things we don't know about the company. We don't know any insider information, which would be nice, but we don't know those things. So it looks to me like we would want to go and look at an options chain for this and see if maybe we could sell some premium and capture all that volatility. So let's do that now. Okay, so here's the options change rate, trade rate, and options chain right now. And if we were to do this, I would want to really go out, far. And why would I want to go out far? Because I would want to be able to, if I'm wrong on this, I want to be able to, number one, adjust my trade if I'm majorly wrong, or number two, I would want to give that trade time to work off. Now we can see that if we go out to the very edge of 2 standard deviations, now one of the things here, which I don't have, which I should have in here, we can see 56%, 62%, 68% on this implied on these volatility levels are really high. It's super high. I'm just going to go and add some delta in here just to take a look at delta. If I'm going to sell these, I typically like to be about 20. So I probably, and 20 would put me around at 22 calls. The market is 1950, so that's about 1.5 standard deviations from current price. But I can get 25 cents for the 23s, So structurally, if we look at the chart, we already know liquidity's been grabbed here at this level twice. That was 22, 23. So 23s looks like a fairly safe trade. Now remember, I wouldn't just sell this nakedly. That's a word. I wouldn't just sell this naked. I would probably do a spread here. And I think probably an even better trade is a 50-cent spread. I don't think we're going to get, like there's 7 cents different, 6 cents different. We'd be risking 50 cents to make 6 cents, which doesn't make a lot of sense to me. So probably, maybe something like this, maybe 23.50s. If we sold, I'm just going to use an example number here. I'm not going to tell you guys how much I'm going to do. We sold the 10s, and we go a little bit, we're getting, if I can get 20 cents on the 23.50s, and then maybe I can get 23.50, 24.50, 25.50. maybe I go 26.50, right? 26.50. Maybe I'll buy 10 here, and we'll have a $300 risk on this, $3,000 risk on this trade for 10, which kind of really just sucks. So you can see here that, let's just do some analysis. You can see here that we're not getting a lot of money, right? Now, obviously, I'm going to try to do it for a better credit than market, but it's not. It doesn't look very good, right? It's not the greatest trade in the world. So I just don't think that this is something that I would want to do. Now, what if we did something different? What if we sold this and bought this? Or sold the 20s, right? Let me just get rid of these here. What if we sold the 20s and bought the 2050s? This trade looks a little bit better. 10. Now, the real question is, do you believe in 30 days from now that UA is going to be underneath $20? And I think it is. I think it's going to be. I personally think we're going to go and we're going to be down here at this liquidity level at 1841. Now, we could probably get there right after earnings. It wouldn't shock me at all if we did. But again, just based on the fact that there's already a terrible estimate on this, we have to think about that. So, in the long run, do I think that it will get below 20 in the next month? And my answer is, yeah, I do, actually. I actually do. Now, I'm not going to tell you how I know that, because it's part of my proprietary order flow. It has to do with some fundamental analysis on the company. It has to do with industry sector. How is the entire industry performing? And there are several other key points that go into that. But I do think this is a good trade. So let's just look at some of our risk here. That looks a little bit prettier. Okay? So, in this particular case, the most we would make is $160, and the most we would lose would be $370. Okay? So, that is not a bad situation to take advantage of these rich premiums. So, that's one option. We're doing options, aren't we? What if we just bought these puts, these at the money these puts at the money, right? So with 8 days left, you can see that up here, August 4th, they're $1.10 with 8 days left. Okay, that's pretty expensive, $1.10. So what if I was right on this trade and we got down to 1836? Well, at least the option would be worth, we just take the difference right now. So if we did it right here, if we 20, that was, what are those options? Sorry. Let me just check those options again. That was the 1950. Ooh, that's not a good one. I think we'd have to do the 20s. Okay, so we'd have to do the 20s because the stock right now is 2014. So the 20s subtract, I'm going to say 1839. $1.61. So if we were right on this particular trade, and they would beat, which I think it's possible, then really we would make 61 cents on this trade. All right, which is basically what we're thinking about, okay? So we're risking $1.61 to really make 61 cents. The difference between this trade and our previous trade, let me get that risk up here. And our previous trade is that in our previous trade, we're risking 370 to make 150. So this is actually almost a better trade, isn't it? As far as your risk return is. Now, the other advantage on this trade is that we would be able to have more time. Okay, now the disadvantage on this trade is we're capped. So the advantage on this trade is we have more time for the stock, even if it beats after earnings, to come down and get spanked again and close by the time of our expiry below 20. However, we're also capped. Now, the advantage of just doing the puts is that we're not capped, right? I mean, we could potentially here blow through 18. We could be very easily down. You can see what happened last time they missed. They missed by 8%, and the stock got absolutely decimated, right? And that was a pretty big move. You know, this thing has a history of moving. That's a 27% move, right? Which is pretty big. You know, we could move 27%. Yes, it moved 27% here as well too, approximately. So this could, if we buy the put, then we have the potential of making a lot more money. So these are, in this particular trade, I really don't see any real great way to capitalize on it. In other words, doesn't mean I'm not going to take this trade. It just means that I'm not going to do a lot of it. Okay? In this context, there is conflicting information. The entire industry sucks. We know that. The company is having serious problems. We know that. There is liquidity at 1830, which is probably going to get hit. Okay? And liquidity above, there's finished business at 23, so there's not a lot above the market that's suggesting that we're going to go higher. So I'm going to say the path of least resistance is lower. However, the expectations are already so low at -6 cents, that it makes it difficult to trade. So if we put all those pieces together, we've built a pretty good context on, should we even be trading this asset going into this earnings season? And again, and if we are, how much size should we be taking, right? And the answer is I don't know. It's a kind of ambiguous situation. It's a bit of a gamble. So right off the bat, if I am going to trade it into this earnings season, I know right there that it's going to be small. I can tell you that much. Now, again, if this had changed, if these estimates for -0.3, -0.2, whole different picture. I'd be taking really big size on this, right? So right now, I don't like the trade pretty much at all. All that, 25 minutes for me to tell you that I don't like the trade at all. But I do think it's worth a gamble for some very small size with some put options. And that's exactly what I'm going to do. I'm going to buy a very, very small amount of put options here. because I think there is more. I think the path of least resistance in this situation is lower, and I think and I think there's also the advantage of potentially even going a lot lower than 18. I don't see that being huge. So, bottom line, I am buying one contract. That's all I'm going to buy. That's how much I believe in this. I don't believe in it very much. I'm going to buy one contract of, where's my matrix? I'm going to buy one contract of, and I'm going to give it 8 days. The 20, I buy one contract, just one, right? And I'm going to convert that trade. Now I'm going to convert that trade and save it in here so that we can come back and look at it and review it. But that's exactly what I'm buying. I'm buying one put contract of the UAA 20 puts expiring in 8 days from now. And my plan is to either lose it all. That's my entire risk, $136. What the hell, I might do two. Make it two contracts. Okay, that's $260, which is well below my my maximum stop loss. My maximum stop loss in this account is about $1,000, so I'm 1/4 my stop loss, and that's the trade. I personally say this trade has I'd say it has about a 70% chance of making me money. I think it has a 50% chance of making me a lot of money. But I do think there's about a 30% chance of losing money on this trade, and therefore that's why I'm going to only do $260. Okay, so I'm just going to convert that trade. And we are done. So there's a whole analysis. Now, this is what I go through. Now, so my final conclusion is the path of least resistance is to 1830 by after earnings tomorrow. But I do think that there's some upside risk here, so we're going to limit it. I hope you guys enjoyed that. That's kind of a similar process that I go through. However, every earnings trade. However, I go into a lot more analysis with my one-on-one students because obviously you've got to know my other proprietary methods of measuring things and quantifying things. But this is just a surface level way that you guys could take this information, start making money, maybe follow me on this trade, but remember, I'm only giving it about a 65 to 70% chance of making some money, and there is about a 35% chance of losing on this one. So that's the trade. Hope you guys enjoyed that. Took a half an hour, but I'm going to get it up, and hopefully this time we've got an hour and a half, or 2.5 hours before the market closes, and hopefully we'll make you some money on this. We'll come back and take a look at it. Thank you, and bye for now.